Hi, this is Marcos Lemus with Bulman Wealth Group. Welcome to your Compass Clip. I wanted to hop on here and quickly talk about our three bucket approach with respect to retirement income planning. Everybody's bucket setup look a little bit different, but we begin here with our safety bucket, bucket number one. And this is something we want to think of as an emergency fund, something we can tap into as unexpected expenses occur. And it's not a matter of if, it's more a matter of when. So we want to make sure that we have 3 months, 6 months, 12 months, maybe even 2 years of our expenses covered in the event that those unexpected expenses do arise. And these can come from different places. This could be checking accounts, savings accounts, money market, maybe even CDs, treasury bills, high yield savings accounts, any kind of cash equivalent where we can quickly get our hands on these funds. And these are going to be something that's a little bit more liquid than some of the other things we're going to talk about. So, bucket one is our safety bucket or emergency fund. So, we move on to the middle of the screen here. Bucket number two is our income bucket. And this income bucket can be composed of many different tools. Maybe we're lucky enough to have a pension that gives us guaranteed income for life. Social Security is going to be a big piece of this for many individuals, most individuals. So that's going to be part of our income bucket. Maybe we've got an annuity that has a guaranteed income stream for life, similar to a pension. Bonds, this could be dividend paying stocks that give us income either monthly or quarterly, or maybe even real estate. If we're a real estate investor and have some rental properties that give us pretty predictable income. But we want to think of this middle income bucket as something that serves to provide us income for the first 10 years of retirement, give or take. So if we know that buckets one and two can safely get us to year 10 or even beyond, it allows our last final bucket here, the growth bucket, to grow and appreciate in the market. Now, this growth bucket can be composed of different things, but equities, mutual funds, exchange traded funds, maybe even individual stocks. But we know that we may not need to touch this for 10 years or potentially even longer. It allows this bucket to really grow. Knowing that our first two buckets are covered, this really is where the growth bucket gets all of its time to get that appreciation in the market. And then we can use the growth bucket later to replenish buckets one and two as needed and if needed. Now, as I said earlier, everybody's bucket setup is going to be a little bit different, and it's going to have varying levels of cash or assets in each. But if you have more questions about your bucket setup, is this bucket approach right for you? What do we have in each bucket? Connect with your financial advisor and find out if you need to make any shifts or changes. Thank you for tuning in. This has been your Compass Clip. We'll see you next time. Take care.